Hello everyone and welcome back to the Master of Money program. I'm Steve Beeman, your host, and on behalf of all of us involved, we want to say thank you for joining us tonight. We hope you had a nice holiday season that just ended, and you know, it's one of those things, you and I know it comes and goes so fast every year, but now that it's over, we're back to work. You know, interestingly, over the holiday I had a chance to speak to people about the show, and we had a good laugh about it because we recognize that as we do this, we don't have the most sophisticated show in the news. We don't have fancy, graphics for the show. We don't have the best cameras money can buy. But what we do have, and we hope, is the best content you can find anywhere. Content is our name of the game. And if you're new to the program, we hope that you'll continue to provide feedback to us on our content so that we can improve each and every week. We've been very pleased that folks have reached out to us through our website and sent us comments and thoughts on how we can maybe dig more into detail here or there. So we welcome that. We appreciate it greatly. But I did get a kick out of the comments because we intend to continue this being a fairly basic program in terms of its technology, but always working to improve the content. Now, tonight's show is going to look at something that really just a few years ago would have been considered almost exotic for investing: global investing. But this is something that over the last 20 years has come of age, and whether you think about it or not, your daily life is involved in the global marketplaces. Well, we want to show you tonight why that's evolving, how you can capture some of those returns, and what to look for as you think of diversifying your portfolio around this globe. Highly important, so we hope you'll stick around through the second half for that. Now, as always, we look to last week to kind of guide where we're going to start this week. And last week, you and I spoke about how to hire an investment advisor. We spoke first about the real need people have to hire a professional to help them. I gave examples for in that show about times and people I'd known who were very senior business executives who upon retirement maybe didn't have the best ideas of what to do with their money. So we talked about why you should hire an advisor. We talked about their licensing. We talked about their certifications and their fee structures. And finally, we talked about the SAFE Certified program, a program that the Society is beginning to develop where we will go out and certify advisors to be people we would trust with our own kids' money. Well, we figure if we can trust them with our kids' money, you can certainly trust them with yours. So stay tuned to learn more about that program as it develops over the course of the year. We also gave you an update on Superstock and the final closing year commentary on that trading little blip you get at the end of the year. We hope some of you took advantage of that. And we talked as well about the consequences in taxes of mutual funds versus ETFs or exchange traded funds. We hope you took that to heart as that year came to an end and didn't get saddled down with some of those unintended mutual fund taxes. So that was a good show. We were appreciative of the feedback you gave us. As always, feel free to write us at questions@safefinancial.org. That's the site we use, or the email that gets the questions from viewers, and we try to look through those and answer them as best we can. Each week we pull one question and we answer it here on the air. This last week, one of our viewers wrote to us, "I hold unit investment trusts. Are those tax efficient?" Well, that's a good question, and on a future Master of Money program, we are going to look into unit investment trusts as a possible tool for you. But to answer that person's question, and I hate to say it, but it depends. Unit investment trusts come in all types of styles and formats. And when I say that, I mean the monthly duration of the trust. You can have a 1-month trust, a 6-month trust, a 13-month trust. If you hold one of the 13-month trusts, yes, it's relatively tax efficient because all of your gains have been pushed into long-term capital gains. Shorter than that, there's really no tax issue with unit trusts because they're coming in the short-term capital gains arena. But if you're looking at unit investment trusts for your portfolio, talk to your advisor about 13-month trusts. That will push you into long-term capital gains. And that's an awfully nice immediate increase in your returns. So we hope that was going to help. And by the way, I wanted to mention, I made a special note. For those of you filing a 1040 this year, which I would venture to say is all of you, there's going to be a new box. And you have to check it at the bottom of the form. And that box covers indicates whether or not you have health insurance. Yes, this is part of the new Affordable Care Act. And for some of you, I fear it hasn't been so affordable. But that box signifies that you carry insurance and therefore aren't subject to the penalties. Now, on the penalty, I want to bring this up because people are really concerned around the country about whether they're going to get hit with a penalty. First of all, there are two things. First, the penalties are relatively small. I think it's a couple $100 if you don't have insurance. The bigger thing to note is from everything I've read, and I'm not an attorney, so I don't want to give you legal advice or accounting advice. I'm not an accountant either. But ask your professional advisors whether or not they can collect that penalty on anything other than a tax refund. I don't think they can. And since many of you filing don't get refunds, even if you don't have insurance, they can't collect that little penalty. So it's not as bad as people are worrying about. I think you have to look at your specific example and look to your advisors to know whether you're subject to the penalty or whether you have insurance that qualifies. But at any rate, I thought I'd bring it up to you because we are going to be approaching that April 15th deadline before we know it. Now, in the program, as you know, I like to give you updates on everything going around the world. We look at geopolitical events, economic events, and indeed financial events. In the geopolitical side, typically I'll pull one or two things out of the news that I think are relevant. Well, this week's a little different. I pulled an article from Time magazine, and I pulled out what they called their top 10 geopolitical risks for 2015. I thought it was interesting because within each of these, you and I have already talked about it. So I was very pleased that the viewers of the Master of Money are already above their Time counterparts. But I want to review this for you, if for no other reason than to tell you that we're not the only ones who think these are important. They're number one, the politics of Europe. We've talked about Europe sinking back into recessionary issues, largely based on their problems with Russia. This is coming up more and more lately, and we'll talk about that a little bit in the future of the program. But the European economy has not exactly been strong. And as we go through 2015, the debt loads that some of those countries carry, as well as the lack of economic growth, has us very concerned. Number two on their list, and we've talked about this one ad nauseum, is Russia. Yeah, there are a lot of issues with Mr. Putin's Russia. We know that he was a fan of the Soviet Union and would not mind rebuilding that. In fact, I think he's probably more akin to building the old Russian Empire. But with that said, the sanctions that have been put on him for his aggression in Ukraine is really beginning to hurt. And when you take those sanctions together with $50 a barrel oil, or a barrel of oil, you've got a real problem in Russia. Time magazine brought that up, and you and I have talked about that at great length, so there's certainly no surprise there. They talked, number three, about the effects of China's slowdown, and we've spoken about that, coming off of a robust 10% growth rate in 2013. Last year was more like a 6% growth rate. That's still pretty darn good. Let's keep in mind the U.S. is under 5%. So China's slowing down is causing a lack of shipments into that country, and that is a geopolitical concern for you. Number four, and this one I thought was interesting phrasing. They talk about the weaponization of finance. And what they're talking about is the governments using capital markets as a weapon against their opponents. Now, this is a double-edged sword in my mind, and I think Congress and the President should be very slow to use this. What they're referring to is restricting access to our capital markets if countries around the world don't play by the rules. Well, the fact of the matter is government in control of those markets and using them as a weapon, well, that doesn't end well for our own economy. So I hope they'll think twice about using that particular strategy. Number five, they mentioned ISIS and the problems in Syria. We've talked about these criminals that are running rampant in the Mideast, establishing a real terror network. We're not sure how that will come to an end this year, but we do think it's hit the level of global concern. They've been beheading enough people that we ought to be taking notice, and it's good that we actually are. Number six was interesting. They talk about weak incumbencies around the world, and they're talking specifically about political leaders. If you look at Brazil, Colombia, South Africa, Nigeria, and Turkey, all of these are politically weak, and all offer real opportunities for problems. So we want to keep an eye on those countries. Again, we've talked about the Brazil, Russia, India, China, the BRIC countries. This is just a little addition to that for political instability. They talk about Saudi Arabia versus Iran. Now this is going on in a big way, and most Americans are somewhat familiar with the Islamic issues there. But what we have simply is that Iran is a Shiite country, Saudi Arabia is a Sunni country. And those two factions of the Islamic world are at war with one another. Well, we would certainly be friends with Saudi Arabia much more than we are with Iran. So we would hope that that side comes out on top in that battle. It's mostly the Shiites that seem to cause problems. Not exclusively, but mostly. So we want to watch that Saudi Arabian-Iran situation grow. It does affect oil prices, it affects global economies, and it threatens the nation of Israel. So that creates an entire geopolitical problem in the Mideast. They talk about China and Taiwan, and we've talked about that before, with China making very aggressive statements about reunifying with what used to be called Formosa. Many people don't know it, but after World War II, Taiwan became free China. Well, China became communist under Mao, and those two countries were at odds with one another very aggressively for a number of years. Well, the U.S. stepped up on the side of Taiwan, and we've been one of their, if not their strongest allies. Well, as the geopolitics of the world have changed, Taiwan is getting left out a little bit in the cold. And I think there's concern for many people that China will see this as an opportunity to go back in and take what they believe is rightfully theirs. Well, we'll keep an eye on that for you. And then finally, they mentioned Turkey. Turkey is an interesting country because it binds together the Middle East and Europe. Turkey's had some real instability problems lately, and we continue to see that there. Economically, because they're affecting this trade between, again, the Middle East and Europe, they're very powerful, but they're politically very unstable. So as Turkey goes, so could those trade routes. And that, again, would affect not just the Middle East, but oil shipments around the world and the economy of all the countries there. So we want to keep a real eye on that. Moving into the economic side, this year begins a year in which 21 of the 50 states in America have raised their minimum wage above federal minimum wage regulations. Most people don't know this, but the federal minimum wage is $7.25 an hour. And at least 21 states, it's expected by year end it will be 29, have a higher minimum wage than does the federal government. Now we'll see ultimately if this economically really does benefit people. In fact, we could do a whole show on the minimum wage. There are arguments on both sides of that equation. I would come down and say the margin, they're not going to help anybody and they're going to cost some jobs at the low end. But we'll see what the result of it is as those 29 states grow out of the 21 that begin. And then finally, in the economic side, I want to go back to Europe because there was an article I read coming out of CNBC talking about the deflationary pressure on the European economies. As that continent has come through the year, their central banks have been flooding currency like ours into the economies. But with the sanctions on Russia, which are greatly affecting Germany and Italy, they do a lot of trading with Russia. As they've slowed down their exports, their economies have slowed, and even these central banks can't flood enough money into them. So they're worried about a deflationary cycle. And if you study economics long enough, you'll know that deflation is the enemy of all of us. We don't want to see that. But right now, European central banks are a little bit tied up. They don't know what to do. So we're going to continue to watch very closely what the central bankers in Europe do. They'll follow the lead of the United States Federal Reserve. So Janet Yellen, in her position as chairwoman of the Fed, will have a great deal of impact on what Europe does. So we want to tie that together. And of course, it's very timely because tonight we're talking about global investing. In the financial markets, for the year we ended up nicely. I mean, we had, what were the numbers? The Dow was up 6%, the S&P 500 up 10, and the NASDAQ up 13. Now that shows you there's a favoritism to the smaller companies who did quite well. I don't think any of us would complain with a 13% return. But we did see a little sell-off at the end of the year. In fact, just yesterday the markets came down a couple of percent. And they're driven to that because of this problem with oil. We've talked before, as oil comes down, it's good for the consumer. It's bad for a lot of countries that rely on it. So that caused yesterday's sell-off. But generally we had a pretty good year in the markets. If we look at our friend the VIX, that volatility index, that thing soared a whopping 60% last year. Now, it had some volatility of its own through the year, but when you look at that kind of gain, what it's telling you is that the institutional world is looking for more volatility in 2015. But we'll keep an eye on that and report to you each and every Tuesday here on the Master of Money. Now tonight, as I said, I'm going to talk about a topic that you're involved in, whether you think about it or not. The fact of the matter is, whether you buy coffee at 7-Eleven, you go get your gas at Royal Dutch Shell, or you buy a Budweiser, and I think they're foreign-owned now, you're buying from companies that are owned in the global markets. If you're buying stock in General Motors, GE, Microsoft, Apple, well then you're buying global companies. The fact is, international investing has changed grandly over the last 20 years. And tonight, I want to talk to you about why it's happened. It's not all bad, and I think a lot of people think it is, but it's happened for very rational reasons. And then I want to talk about how you can implement strategies that take advantage of it and make money for you. That is, after all, what we're about here on the Master of Money. So, I want to share a story with you. As you know, before we go to break, I like to share a little interesting story if I can find one. And I will tell you, I saw this last week and it humbled me greatly. I've often thought that financially speaking, I've done pretty well in my life. Having built and sold a company, I was pretty happy with how I'd been until I read this story. It seems that just last week, our president, who's vacationing in Hawaii, had dinner at a club. The club's name is the Vintage Cave. I urge you to look it up. The funny thing about the Vintage Cave is that in order to dine there, you have to be a member. Well, I've belonged to private clubs. They're usually not that bad to belong to. Well, this particular private club is $500,000 to join. That's a very expensive dinner. And it certainly humbled me and made me realize maybe I haven't done as well for myself as I thought. But when we come back, nonetheless, we're going to talk about global investing, and we hope you'll stick around for that. We think it's going to be very important as we try to link on this the academic to the practical. Those are two equally and equivalently beneficial sides on this argument. So we look forward to seeing you when we come back. Give us about 2 minutes and we'll be right back.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors, because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to the program. You know, it's kind of scary sometimes, change. In fact, As you get older like I have, you start to realize that the only consistent thing in life is change. But change can be very scary for some people, and we are now in a world that's changing so rapidly in three primary directions: social change, economic change, and political change. Now, as you look at those three things coming together, it creates an environment where investing becomes very difficult. How do we predict trends? How do we predict economic issues? Well, all of those come to bear when you look at international investing. What we want to try to do as we work through the Master of Money is to give people the content they need so they can transition from being afraid of it to exploiting that change for gain. Ultimately, that's what your portfolio is about. Whether you're in this for your grandkids or your kids or yourself, making gains is where we all share the same idea. But let's start with some basics, shall we? Global investing first. It is here and now and used by everyone. As I said earlier, whether you go to 7-Eleven and buy a cup of coffee or you go to any one of a number of stores, Burger King just got sold to the Canadians. No matter almost where you shop anymore, you're buying products of a company owned globally. You're using product imported from China. You're using product and selling product in your company overseas. We are very much an integrated economy now, much more so than we've ever been. And what's interesting / scary to people is how fast it happened. It really did just come upon us. The good news is, though, even with this change, the fact of the matter is, with ETFs and mutual funds and what are called American depository receipts that trade on the exchanges, you can invest in companies that make money around the globe. You're no longer limited to looking at companies like Disney that might focus their earnings here on the U.S. The fact is, today you can go out anytime, day or night, and buy investments from China, Brazil, Russia, China, I think I said that twice, anywhere. And that's a good thing, but you have to know what you're doing. Now, the reason this has happened, and let's take a look on some of the issues. I talk to people all over the time around the country and frequently have people that are afraid of the United States no longer being the center of attention economically. You know, it was once said, when the United States sneezes, the world gets pneumonia. Well, it's not quite that dramatic anymore. When we sneeze, the world now just gets a really bad cold. But we still guide the world. We're still we're not the largest anymore. China's now the largest economy. But we are certainly the most productive economy. And as that changes, though, people get scared. But the reason for it's not all bad. If you look at the United States from 1776 up to the 1980s and 90s and through 2000, we were the new kid on the block. We were the fast start, upstart company. We were the Apple computer of the global nations, if you will. Well, as any company grows to maturity, the United States has grown to maturity. So we're no longer going to be the big economic driver for the world. We're going to be the mature, stable driver. We're going to look to things like these BRIC countries you've heard me talk about, of Brazil, Russia, India, and China. We're going to look at those countries to bring their impoverished peoples up to middle class, and that's where the opportunity lies. A couple of weeks ago, you and I talked about Cuba and the fact that our government is now considering opening relations. Well, a lot of companies in the United States like Caterpillar, Archer Daniels Midlands, these companies are very excited about this opportunity because rebuilding, or I should say just building the infrastructure for Cuba is going to be a huge moneymaker. It's a little hard when you already have everything to add to it. Well, we in the United States have a great deal. But when you walk over to Africa or you walk through South Asia, you realize these countries need basic things that we take for granted. That opportunity is extremely real. And that's where you and I can make some real money over the next 10 to 20 years. So the fact is, we've seen the United States transition into this stable economy. And as other countries grow, as I said, using ETFs and mutual funds and American depository receipts, you can invest in these companies. But the question that comes back to me, and I hear it time and time again when I talk to people about global investing, what comes back to me is, well, how do I do it? How do I look at companies overseas? And I will typically smile and say, just like you would here. If you go over and look at, there was a new company, I forget the name of it, it just came out, it's the eBay of China. I was actually involved in, it's called Alibaba, forgive me. I was involved in Alibaba as a vendor of mine 10 years ago. But they just went public, and they're now in fact, I think they are the world's largest distribution company. Well, you say, what do I look at an Alibaba? How do I judge it as a company? And I would say to you, judge it just like you would any other company. Take a look at the upside versus downside risk in the company. If they win, how big is the win? If they lose, how big is the lose? Basic stuff. Remember the old adage, how do you make money in the markets? You buy low and sell high. It is pretty simple. So we want to look at the upside and downside risk. We want to look at the fundamentals of the company. They still matter whether they're traded in Beijing or in New York. No difference there. We look at the fundamentals. We do look at company-specific issues, valuation, growth rates, momentum, and we look at industry dynamics, sales growth, revenue growth in the industry, possible governmental impact on that. There's a lot in the industry level stuff you can study from supply and demand just to see whether that industry is a growth industry or not. So those very company specific things are almost identical to what you look at. In fact, to go back to my history, when I had Chicago Investment Analytics and we built stock selection models to predict U.S. stock price returns. Well, those same models can be applied to overseas companies. There's not a lot of difference. Now, there is an availability of information issue, but once you cover that, and that's getting better by the day, evaluating Alibaba is no different than evaluating eBay. Now, there is a second dimension, though, and these are kind of a dimension that you need to understand, and that is that first, you have to understand the country that hosts or domiciles the corporation. Around the globe, you see different laws for taxes, regulations, and you see political instability in some countries. You want to avoid companies that are headquartered in Venezuela, obviously. They might get nationalized. But the fact of the matter is, in most free countries around the world, whether it's Australia, the Swedens, Norways, United Kingdom, Japan, these companies have very stable governments. They've got good environments for a company's headquarters. And so you don't have to worry about it, but you do want to watch their tax policies. And then the final dimension you want to look at, and this is one you can make a good deal of money on if you become schooled in it, and that's their currency. There are dynamics in currencies that are very interesting. We live in a world of a floating currency where there's really no fixed value to anything. And therefore these currencies trade relative to one another. Okay? So right now the dollar trades relative to the euro at a price. It trades relative to the Chinese yuan at a price. And that dynamic change in price greatly affects the numbers you'll see as an investor. If, for example, the US dollar is getting stronger, well, that's going to benefit consumers in the United States at the expense of exporters. The opposite is true, that if we have a weak dollar, then we have strong exports and harder on our consumers. Different companies react differently to that type of thing, and you want to make sure to the extent you're involved in an international investment, and I'm going to go through a few of them here to talk about it, but you want to make sure that the currency issues aren't going to hurt you. It's very possible you buy the right company, the right industry, in the right country, but their currency collapses relative to the dollar and you're left with nothing. So we want to make sure that currencies don't come back to bite you. But a lot of traders will tell you that currencies are the best things to trade. They're incredibly volatile. They move fairly large amounts in short periods. So you can make money trading these currencies. We'll have a program on that one of these days. In fact, next week, and I was going to mention this, but next week I want you to make a special note to join me. I'll be joined for the first time with a guest. We're going to have Jeff Garbaz of Quantitative Partners come on, and we're going to talk about trading. So you don't want to miss that show. But I want to go back to that because learning how to do that can be an enormously profitable venture. But learning how to do it wrong will hurt you every time. I go back to the old poker analogy that if you sit down at a poker table and you don't see the fool, then you're it. Well, trading currencies or futures or options is the same way. If you don't see the fool at the table, you're it. So I urge you to learn all you can about those particular activities before you get snookered in to losing all of your money. Now, if we go around the globe and look for some ideas, I pulled a listing from several sources, and then I combined them and correlated them to come up with kind of this global top list. And I wanted to go through it because the returns are hugely diverse from around the world. Last year, the best return you could have gotten was in the iShares Global Commodities ETF. The ticker on that's GSG. It returned 34%. Not a bad return. If you looked at the worst performing, again, this gives you an indication that it wasn't necessarily a bad year. The worst performing was the Global Telecom ETF, and it only returned 39 basis points, or 0.39%. So that's a pretty wide spread. So I wanted to give you, of the hundreds of ETFs that trade in the global arena, I wanted to give you some specific ideas. First is the Vanguard Total World Stock Index Fund. It returned only about 4% last year, but it's very stable. It's very diversified around the world, so you get good exposure to the entire world. Now again, it didn't perform as well as the U.S. did last year, but who knows? Perhaps a regression to the mean is coming up on this one. Anyway, take a look at the Vanguard Total World Stock Index. Secondly is iShares Morgan Stanley All Country Minimum Volatility Fund. That returned about 11%, which is pretty good. None of us complain about double-digit returns. And again, very stable return on that fund. Very low expenses as well. And finally is the iShares Morgan Stanley ACWI Index, which is the All-Cap World Index. They did about 4.75% last year, a little under 5%. Again, not great, but the U.S. markets, as you saw, weren't that great. We were about 6% on the Dow. So as you diversify your holdings around the world, what you're doing is quite possibly capturing the larger growth of those other economies. But if you're buying into good companies, or I'll say good countries in these ETF worlds, buying into good, strong sectors, you should be fine, and you should be able to hedge your American bets very, very nicely. Now, if we want to continue with our super stock work, Jeff has been kind enough each week to provide us information from Superstock Investor. You can visit them on the web. Their site is now being shown to you. And Jeff kind of gives me a commentary every week and gets his thoughts into what's going on. And what was interesting is actually yesterday you saw the market sell off quite substantially, a couple of percent. Well, Jeff sent me a note today talking about how often that happens. In fact, there were 19 trading sessions in 2014 where the markets were down by over 1%. There were 5 times where the market was down by more than 2% in a day. The point with that is don't be concerned when you see small volatility. It happens. I go back again, and I've given the example, but a few years ago, from a Monday to a Friday, I was on the radio being interviewed every single day because the markets were so volatile that week. Down one day, back the next. Down one day, back the next. The funniest thing about it, if you look at where the market started the week and ended the week, identical. So don't be too afraid of the volatility. Sometimes it can cause people to make bad decisions, and I wouldn't want you to get caught up in that. So that gives you a perspective. Just a quick update on the stocks we've looked at. We've shown you 4 of them so far. Ford, which opened at 14.37 after we recommended, it's now 14.75, a decent gain on that. Now again, the purpose of this isn't necessarily to give you the hot stock idea, but we want to talk about the process we use to look at these. All of these had good fundamentals. They have good management, good markets, good industries, and their volume swing was beginning to improve, meaning that more people were coming into the stock. Cisco has now moved to a 52-week high at a little over $27, but Google is down a little bit since we suggested it. It's down from 526 now down around 519 as of Monday. So as you can see, we're not always going to give you stocks that go up all the time. A lot of these stocks, you look at Google, it's very correlated to the market in general. So when the market sells off, it's going to sell. When the market's up, it's going to go up. We'll talk to you about a measure of that called beta at some point. But if we look at Boeing, it's down a little bit. Again, I would argue that it's down just because we had that trading day yesterday. But all of these companies demonstrated the kind of characteristics that we think you should look for as you make your investments. It's not easy. You've got to do your due diligence. So I strongly recommend you do. And again, going back, as we did last week, we want to make sure that you get a professional advisor whenever you can. Now, these people can run the gamut. Some of them are very suitable, some of them aren't. So if you need our advice, feel free to write us at questions@safefinancial.org. Now, I know the program's short. It always is shorter than I'd like it. We can't answer all of your questions, but subsequent to this, we do our live Master of Money program here in the office, so we're anxious to get going for that. But as we did have a wonderful holiday, I'm glad that you're all safe. I'm glad that you enjoyed it. Next week, as I said, we're going to have Jeff join us We're going to talk about trading activities, which we think will be critically important and very, very informative. So as always, we want to thank Harvest Investment Services, one of our primary sponsors, as well as Superstock Investor. I want to thank Ron Blake for providing the music at the beginning and Chris Jans for providing our theme song at the end. It's always a pleasure to be with you, and I look forward to seeing you next week on another Master of Money.